Hello and welcome. Today, we're going to explore some of the best investment strategies for the currency market, from foundational strategies for beginners to advanced techniques for seasoned traders. Whether you're looking for long-term growth or quick, short-term gains, we'll cover everything you need to know to get started or improve your strategy. Ready to dive into the world of currency trading? Let's begin.
Long-term investing in the currency market, sometimes called position trading, involves buying a currency and holding on to it over a lengthy period, often months or even years. The aim is to benefit from a gradual appreciation of the currency's value due to factors such as economic growth, political stability, or other fundamental economic indicators. This approach is ideal for investors who are more interested in achieving steady returns over time and prefer to avoid the high-frequency trading of shorter-term strategies. In other words, it's a buy and hold approach, where investors ride out minor fluctuations and focus on bigger trends. Long-term currency investors often look for countries with strong and stable economic fundamentals. They focus on currencies of nations with steady GDP growth, low inflation, and positive trade balances. For example, if a country is seeing a rise in exports and a stable political environment, it's more likely that its currency will appreciate over time. Interest rates are a major driver of long-term currency trends. Currencies of countries with higher interest rates tend to attract more foreign investment, as they offer better returns. Central banks' policies on interest rates are closely watched by long-term investors, who may choose to buy a currency in anticipation of rate hikes that will make it more valuable. Long-term investors consider a country's political environment as well, as stable governments are less likely to cause sudden currency fluctuations. Additionally, geopolitical relationships and trade agreements can influence currency value, particularly for countries heavily involved in global trade, like the US, the Eurozone, or China. Long-term investing can also leverage the power of compounding, where gains are reinvested to generate further profits. By holding a currency over an extended period, any profits from appreciation can compound, leading to potentially significant returns in the long run. One of the most popular long-term strategies in currency trading is the carry trade. In a carry trade, investors borrow money in a currency with a low interest rate and invest it in a currency with a higher interest rate. The profit comes from the difference between the two interest rates, called the interest rate differential. For example, suppose the Japanese yen has a low interest rate, while the Australian dollar has a higher rate. An investor might borrow in yen at, say, a 0.5% rate and invest in Australian dollars with a 4% return. The difference, 3.5%, is the profit. However, investors must be cautious because if the currency they've invested in depreciates, it could offset any gains from the interest rate difference. The carry trade isn't without risk. The invested currency may decline against the borrowed currency, causing losses. Additionally, sudden interest rate changes or economic shocks can dramatically impact returns. Carry trades are sensitive to global economic events, so investors need to stay updated on any shifts in central bank policies or political developments that could affect interest rates. Currency hedging is another strategy, primarily used to protect a portfolio from adverse currency movements. Hedging can be thought of as a form of insurance, where the goal is not to make money, but to reduce or limit losses. For instance, suppose an investor holds investments in emerging market currencies, which can be volatile. To hedge, they might invest in a safe haven currency like the Swiss franc or the Japanese yen, which are less likely to experience sudden fluctuations. By holding a portion of their funds in a stable currency, the investor offsets potential losses in their riskier currency holdings. Some long-term investors use currency options or futures contracts as hedging tools. For example, if an investor expects a currency to fall, they could buy a put option to sell at a higher price, effectively locking in a price that protects them against a decline in currency value. Long-term investment reduces the impact of short-term volatility. Investors aren't concerned with daily or weekly price swings. Instead, they focus on broader economic trends that can lead to more reliable returns. With fewer trades, transaction costs are lower, which can make a significant difference over time. Unlike day trading, where constant buying and selling accumulate fees, long-term investors pay fewer transaction fees. Holding investments for longer periods allows returns to compound, especially if profits are reinvested. Compounding can lead to exponential growth, a key benefit for those investing over multiple years. However, long-term investments are not as liquid as short-term trades, meaning investors have to be comfortable leaving their capital tied up for extended periods. It also means they can't take advantage of short-term trading opportunities. Long-term strategies require patience and confidence in market fundamentals. Investors may have to wait through market downturns and hold their positions even when prices drop temporarily, which can be difficult without a solid understanding of the factors driving their chosen currency's value. What is short-term currency trading? Short-term trading, often known as day trading, swing trading, or scalping, involves buying and selling within short time frames, sometimes within minutes or hours. Short-term trading is ideal for those who want quick returns and can actively monitor market movements. Examples of short-term strategies: scalping. Scalping is a fast-paced trading style where traders seek to make multiple small profits throughout the day. This approach requires access to real-time data and fast execution to capitalize on very short-term market movements. Range trading. Range trading involves identifying currencies that are trading within a defined price range and capitalizing on that range.
Benefits and risks. Benefits. Quick potential gains. Flexible for experienced traders. Risks. Requires constant market attention, high transaction costs, and substantial experience.
Effective risk management is crucial for successful currency trading. Without a solid approach to managing risk, even the best trading strategies can lead to significant losses. Let's dive into some essential risk management techniques that help protect your investments and maximize long-term success. Stop loss and take profit orders are fundamental tools for managing risk. They allow traders to automate their exit strategy and avoid emotionally driven decisions. A stop loss order automatically closes a trade once a currency reaches a preset price, helping to cap potential losses. For example, if you set a stop loss at 1% below your entry point, the trade will close if the price drops by that amount, protecting you from further declines. Traders often place stop losses at technical levels like recent lows or highs to give trades a buffer while still managing risk. Avoid setting it too close to the entry price, as small fluctuations might trigger it prematurely. Take profit orders, on the other hand, secure profits by closing the trade at a predetermined price level once your target is met. This is particularly useful in fast-moving markets where prices can quickly change direction. Many traders use a risk-to-reward ratio such as 1.2 or 1.3, where the potential profit is at least twice or three times the risk. This ensures that the wins outweigh the losses over time. Using both orders helps traders stick to their strategy and avoid letting emotions like fear or greed interfere with their decisions. Diversifying across multiple currency pairs can reduce the overall risk in your portfolio by spreading exposure and decreasing reliance on a single currency's performance. When you trade only one currency pair, you're fully exposed to the fluctuations of that pair. By adding other pairs, you distribute the risk, making it less likely that a loss in one trade will heavily impact your account balance. For instance, if you're trading both EUR USD and USD JPY, a decline in the euro could be offset by a rise in the yen, balancing your overall exposure. Not all currency pairs are suitable for diversification. Some pairs move in the same direction due to correlations. For example, EUR USD and GBP USD often correlate because the euro and the British pound are both influenced by the US dollar. Use currency correlation tools to select pairs that are less likely to move together, such as EUR USD and AUD JPY, which may respond differently to economic events. Reducing exposure to correlated pairs can improve the effectiveness of diversification. Position sizing and leverage control are two of the most critical aspects of risk management, as they directly determine how much of your capital is exposed in each trade. Position sizing involves calculating the size of each trade based on the amount of risk you're willing to take. Professional traders often recommend risking only 1 to 2% of your account balance per trade. This way, a single loss won't have a devastating impact on your account. If you have $10,000 in your trading account and decide to risk 1% per trade, you'd limit your risk to $100 on that trade, adjusting the position size accordingly to match the level of risk without overexposing your capital. Leverage amplifies both gains and losses, making it essential to use with caution. Although high leverage can lead to larger profits, it also means greater potential losses if the market moves against you. Experienced traders typically avoid over-leveraging. A common recommendation is to keep leverage low, such as 5.1 or even less, to avoid overexposure and minimize the risk of significant losses in a single trade. Starting with low leverage allows you to manage risks effectively and gradually build experience and confidence. Incorporating proper position sizing and cautious leverage use can protect your account from significant losses while still allowing for healthy gains. An effective risk management plan involves setting a favorable risk-to-reward ratio, which determines whether a trade's potential profit outweighs the risk. Traders use a risk-to-reward ratio to assess whether a trade is worth taking. A 1.2 or 1.3 ratio means that for every dollar you risk, the trade has the potential to earn twice or three times that amount. This way, even if only half of your trades are successful, your overall gains can still outweigh your losses. Suppose you set a stop loss at 50 pips below the entry price and a take profit at 100 pips above. This results in a 1.2 ratio, where the potential profit is double the risk. Consistently evaluating your trades and sticking to your risk-to-reward ratios can help improve profitability over time. Reviewing your trades and making adjustments based on performance is key to long-term success. By following these risk management strategies, traders can create a more balanced and sustainable approach to currency trading, allowing them to handle losses effectively and build profits steadily. All right, so far we've covered long-term and short-term investment strategies as well as the importance of risk management. Now, let's dive into some of the most popular trading strategies used in the currency market. Trend trading is one of the most popular and straightforward strategies in the Forex market. It involves identifying the overall direction of price movement, upward or downward, and making trades that align with the prevailing trend. Traders analyze price movements to determine if the market is in an uptrend, higher highs and higher lows, or a downtrend, lower highs and lower lows. They use technical tools like trend lines, moving averages, and the relative strength index, RSI, to confirm the trend's strength and direction. In an uptrend, traders open buy positions, while in a downtrend, they open sell positions. Let's say the EUR-USD pair has been steadily increasing, and the 50-day moving average crosses above the 200-day moving average, a classic sign of an uptrend. A trader might enter a buy position, aiming to ride the trend for as long as it continues. Now, let's discuss the advantages and disadvantages. The advantages are that it is simple to implement, suitable for beginners, and effective in trending markets. However, it can lead to losses if the market suddenly reverses or enters a consolidation phase. Next, we have the breakout trading strategy. Breakout trading focuses on capturing large price movements that occur when the price breaks out of a key support or resistance level. This strategy is ideal for volatile markets. Traders identify significant price levels where the market has previously reversed, support and resistance. When the price breaks above resistance or below support, it indicates the start of a new trend, and traders enter the market. Tools and indicators include support and resistance levels and volume, as a high trading volume during a breakout signals strength and reliability. Imagine EUR/USD has been trading in a tight range between 1.10 and 1.12 for several weeks. If the price breaks above 1.12 with high volume, it signals a bullish breakout. A trader might open a buy position, expecting further upward momentum. The advantages of this strategy include the potential to enter trades at the beginning of significant moves and that it works well in high volatility markets. On the downside, false breakouts can occur, leading to losses. Now, let's move on to the scalping strategy. Scalping is a fast-paced trading strategy where traders aim to profit from small price changes within very short time frames, such as seconds or minutes. Scalpers open and close multiple trades throughout the day, targeting small gains from each trade. They typically use short time frame charts, 1 minute or 5 minute, and trade highly liquid currency pairs like EUR, USD, or USD, JPY. Tools include short-term charts and indicators like moving averages and Bollinger Bands to identify entry and exit points. The advantages of scalping are frequent profit opportunities and suitability for volatile markets. However, it can be stressful, requires intense focus and quick decision-making, and transaction costs can add up due to frequent trading. Next, we have the swing trading strategy. Swing trading is a medium-term strategy where traders aim to capture price swings in the market over a few days to weeks. Swing traders identify levels of support and resistance and trade based on price reversals around these levels. For instance, they might buy near support and sell near resistance, or short sell near resistance and cover near support. Tools include price patterns, e.g., triangles, head and shoulders, and indicators like Fibonacci retracements and the moving average convergence divergence, MACD. The advantages of swing trading are that it is less stressful than scalping or day trading and requires less screen time. However, traders may miss out on larger long-term trends, and trades can still be affected by overnight news events. Now let's talk about the reversal trading strategy. Reversal trading focuses on identifying points where the current trend is likely to change direction. Traders aim to enter at the beginning of a new trend. They use tools like candlestick patterns, e.g., hammer or engulfing patterns, or indicators such as RSI to spot overbought or oversold conditions that signal a potential reversal. For example, if RSI drops below 30 and then rises above it, it may indicate the start of an upward reversal. The advantages of this strategy include high profit potential if the reversal is correctly identified and suitability for traders seeking early entries into new trends. However, it is difficult to predict accurately, and there is a high risk of losses if the reversal fails to materialize. Finally, we have the news trading strategy. News trading involves making decisions based on major economic and political events that can cause significant volatility in the currency market. Traders monitor economic calendars for high-impact events like central bank decisions, GDP reports, employment data, and political developments. They then trade in anticipation of or in response to the market's reaction to these events. For example, if the Federal Reserve announces a surprise interest rate hike, it's likely to strengthen the USD as investors flock to higher returns. A news trader might open a buy position on USD or JPY to take advantage of this development. The advantages of news trading include opportunities for large profits during high-impact events and that it is directly tied to real-world developments. However, it requires quick decision-making, carries a high risk due to sudden market fluctuations, and can experience slippage during volatile periods.